The broadcast is now starting. All attendees are in
Good
listen-only
evening,
mode.
ladies and gentlemen. My name is John Needham. I'll be your host for this webinar, and I'm delighted to have you with us, and I'm delighted to be with you. Okay, well, our lovely people here, would one of you please type in the question box that the volume's okay, that you can hear me all right? One, two, three, 1, 2, 3. I'm not seeing anything. Mark. Thank you, Mark. Must be a pretty slow connection. That took a while to come through. I know we're a long way away. In fact, I was told last week it's 279 separate hops from my computer to GoDaddy in Denver. Takes a while, doesn't it? Oh, and Yawn is with us. Yawn's middle of the night for you, my friend. Wonderful to see you. That's absolutely grand. Okay, so whole lot of stuff to tell you, and starting with last week, which was for me, it was a week of Cyclone Alfred, which is very unusual for a cyclone to come this far south. It's 55 years or thereabouts since a cyclone came down as far as the Gold Coast, but it did, and it came in on or made enough damage on Thursday of last week. Only last week, it seems like a year ago. That was a bad experience. Anyway, last week, Thursday afternoon, we lost power, and we lost the landline, and we lost all cell phone coverage, and we lost the internet. So what do? We're sitting here in the dark with no computer to look at, no television, no cable. It's gone. And it's getting fairly fearsome outside. It's getting stronger and stronger. And what Alfred actually did, it just hovered off the coast for 3 days, getting stronger, switching between a Category 2 and a Category 3 cyclone. Very damaging, all of them. A couple of $1 billion worth of damage around my area and north up to Brisbane, the capital of the state of Queensland, which is pretty much where it made landfall eventually. But it just sat off the coast, just pelting us all with wind and rain and lack of power, etc., etc. And eventually it came ashore. It got rid of most of its fury out there, and it came ashore as a tropical depression. And it's hard to describe how much rain we had. It's really extraordinary how much rain we had. And what do you do when you have no internet, nothing to see on your computer, nothing on television, no lights? What do? Well, if you're my generation, you read. The younger generation, they're just so dedicated to electronics, particularly phones, cell phones, that they don't know what to do. My daughter now is a doctor at Royal Brisbane Hospital, so she could at least get a hot shower in there because they've got generators, of course. But my son, he was really at a loose end with what to do. So I sent him down to Newcastle, which is about a 7-hour drive away. Get down there. He got a couple of mates down there, and of course they weren't affected, so he had a normal life down there. But what we were doing is we were reading, and I read a number of very, very interesting books. The first one was a very detailed analysis and account of the Battle of Midway. It's over 7,700 pages long, which will tell you how detailed it was. And I'm a bit of a history buff, and I really enjoyed it. It was wonderful, the detail of it, and looked at it from both sides. The American U.S. view and the Japanese view. Very balanced, I thought, and very informative if you're a history buff. From there I went on and I read a story written about the can't remember his name now. This is what happens when you get old. You start forgetting names. And I know the bloke personally. He's a wonderful man. He was the first guy to sail around the world non-stop, single-handed. And it's a hell of a story because he was a he was a member of the Merchant Marine and also training in the Royal Navy Reserve. And he didn't have much money, but he had a boat that had been built with him and a couple of friends in India, which he then sailed from India back to UK, his home. This thing's only 32 feet long. Now, my ilk, don't even talk to me about anything less than 50 foot. 32 feet, a tiny little thing. Anyway, he did it, most amazing thing, 300 odd days, sailed right around the world single-handed. An incredible story of courage, of bravery, of skill, of his training, and discipline, as much as anything, discipline. And remember, this was 40, 50 years ago. I guess, and they didn't have the electronic age we've got now. There was no satellite, there's no sat-nav, radios were pretty limited, and pretty much he set off with an old clock for his timekeeping to get his longitude and a sextant, and that's what got him around the world. Quite extraordinary. And then finally I read a thriller, a book called Witches and Lost Children by I gather she's a young lady called C.A. Rin, R-I-N. You can get it on Amazon. It's in an ebook form as well as a paperback form. A very, very great read, and a racing. You're just flipping the pages as fast as you can, and I love that sort of urgency that you get in some very good books. Anyway, that's where we are. Let me tell you that eventually we survived. We spent 7 days. It was Friday last week before we got power back. And we got cell phone coverage late on the Thursday, and we got power back eventually at 9 p.m. On Friday. And our little generator kept chugging away. It ran for 7.5 hours on a full tank of fuel, which was 6 litres. And Mrs. Needham and I are now absolute experts on fueling, oiling, servicing, starting and stopping small generators. It's a skill that I don't think you necessarily want to wish on yourself, but there you are. It all happened. Okay, let's move on. So here's my friend John. Mark's with us. Lots of our good people are here. Steve's with us. Rolf down in Melbourne's with us. Thomas Van Steenberg. Welcome, Thomas. How lovely to have you with us. Vicky, of course. Wonderful to have Vicky with us. And Pietro's with us. He's either in Austria or he's in Indonesia. Phillips are with us. Milton, important, have been with us for many, many years. Wonderful to have you, Milton. Mark L, of course, no party without Mark. He's an absolute stalwart. The two Gregs are both with us. Greg Palladini, great friend of the Danielcode, and the other Greg, who had a wonderful business in Colorado Springs when I met him. Lovely man. Now spends most of his time in Texas. Gigged out in North Carolina with us. George is with us. The other George, well, there's 4 or 5 Georges today, unusual. Good to have you all. Gabe's with us from California. David's with us. Welcome, David. You're a newcomer, I think. Chase is with us. Anthony, haven't seen you for a while, mate. Great to have you with us. And Adrian, of course, who's in the middle of doing a tutorial and has written to me saying he'll email me, set up an appointment for our next masterclass session. Wonderful. Okay, so let's have a look what we've been doing. Today, I'm going to show you something immensely important. And to get to that state, I've got to show you what some of the other practices are in this business. So I want you to be really, really careful. I'm not recommending those alternates. In fact, good idea is to stay right away from them. But learn to trade the Danielcode, particularly the Danielcode time signals. Creating and trading Danielcode time signals, that's where the big money is. Okay, so much to talk about. If you have a moment, I suggest you take 20 minutes and have a look at one of these videos that are on the homepage of our website, www.thedanielcode.com. They're all testimonials from Mark L's one of them. Justin has done both of them, video 3 and video 4, and continues to do back testing and analysis for us. Wonderful young man. And a young lady from video 2, never seen a chart before, didn't know anything about trading, and was finishing up with 500, 600% on margin in a paper trading. So my purpose, folks, is to give you the answer to everything. That's what I'm striving for. I want to know the answer to everything that happens in the market. And this is going to take you, what I'm going to show you today is going to take you much, much closer to that aim. In fact, excuse me, morning hay fever. The two words you should never use in talking about trading are always and never. Because what we're really doing is we are trading probabilities, and that's all they are. Indeed, some of the probabilities with Danielcode get very, very high, approaching 100%, but it never gets to 100% because they are probabilities. But my purpose is to give you the answer to everything. Everything you see on charts, what it's doing, I know what it's doing. Now, that's a big statement. And I'm going to take you that step closer today. And actually, I've been talking about this to you for the last number, maybe 3 or 4 of our most recent webinars. And I'll come to that in a moment, but just an outline about the headline, or the name for today's webinar, is that markets, equities at least, are down and traders are loving it. And the whole point of Futures and Forex, they're derivatives, that they have a second degree market based on the index price, basically adjusted for traders' optimism or pessimism. So it looks scary, as you can see from the blackboard picture beside this, but it's not. It's really the simplest and most straightforward method of trading. And quite literally, I taught this to my 8-year-old daughter. I've taught it to a lot of people. You can, if I can do it, you can do it, I promise you. And there's so much jargon, and you know, at times you think these guys are just doing this to confuse me. But most of the issues that are sort of different or complex come about for historic reasons. There's no one's having a go at you. All everyone wants you to do is trade well, make a lot of money, and be healthy and happy. So understanding futures, it comes down to simply trading for the differential in the price. Futures contracts are standardized contracts designed, monitored, implemented through an exchange. And I've put here a lit exchange. And a lit exchange is like the CME. It's one you can see. It has light. It has some element of truth and equity in them. But more and more there are dark exchanges, which are private exchanges where the big firms have managed to massage the regulator into giving them this opportunity to match their clients' trades and what have you, in the supposed argument that this is good for the market. Well, the regulators have a funny idea. They've pretty much all been captured. With regulatory capture, the most common thing that happens with regulated anything is that the regulators get captured by the people they're supposed to be managing and overseeing. I mean, think of a proposition that I said to someone, I'm going to offer a service where everyone's going to lodge their orders with me, and I'm going to take those orders and I'm going to sell them. And I'm going to sell them to another broker. and the broker's going to pay me for the privilege of having that flow through. Well, that's the story about the exchange that's called Robin Hood, the broker that's called Robin Hood. They don't charge the client, they on-sell it to the really big players. If that's not a conflict of interest, it's really hard to think of what would constitute a conflict of interest. If as a regulator you're okay with that, you're pretty much okay with everything. But anyway, that's just an old lawyer's view. Obviously, the world moves in ways to implement innovation, and there's always a good argument for it. So we've got futures contracts. Most of you know this, folks, so I'll just run through it briefly. Host of commodities: gold, silver, copper, beans, wheat, equities, number of different forms, bonds, interest rates. And Futures and Forex provides substantial leverage, and it's that leverage that makes trading, if you can get it right, so intensely profitable. So a futures contract basically gives you a right but not an obligation to buy or sell the underlying, which would be any of those issues we've mentioned above and a lot more. You can even trade tiger prawns, would you believe it? And tiger prawns, yeah. So buy low and sell high, or sell high and buy low. The great thing about futures is it pays both ways. You make just as much money with the market going down as you do with the market going up. So you think of those poor investors, they're sitting there reading their daily paper week after week. Oh, my stock's gone up. That's great. I've made a bit of money. Next week, stock's going down. I'm losing money. Futures trader, by complete contrast, says futures have gone up. I'm making money because I'm long. Next week, they're saying futures have gone down and I'm making exactly the same money because I'm short. In other words, knowing the trend is the vital mechanism for successful trading. So there's much more of this stuff on the Danielcode website. There's literally hundreds of webinars talking about markets and trading, and you should take some time and go through them. There's much to learn, and it's all there for you. Now, we need to have a little bit of an understanding of what's driving markets. As a futures trader, you may say, someone's buying a ton of futures, market's going up. You might say the next time, oh, someone's selling this thing, they've lost confidence in the market, market's going down. Well, that's only one of the ways that markets move. The other way that they move is that people are actually buying the underlying. Let's think about equities as a simple example. When you're buying a contract or selling a contract in the S&P futures, the S&P, there's a contract for the Dow, which is the 30 largest industrial companies. There's a contract for the NASDAQ, which is 100 big tech companies. There's the S&P 500, which is 500 stocks listed on the New York Stock Exchange. And then there's the Russell, which is the small cap, 2,000 small caps having lower capital standard or requirement than to fall into that lower cap basis. Now, that's all happening on a stock exchange. And what we're doing, we're a bit parasitical in what we do. We're like the wasp that lives off the back of the creature and eventually kills it. But we don't kill it. We help it along. But what we're doing is we're trading essentially what the stock market is doing. That's just talking about equities. Same thing applies to commodities, gold, everything else. There's the physical market, or I call it the underlying market, and then there's the futures market, which takes those values on a second-by-second basis and adds a premium if the market's optimistic, or a discount if the markets are pessimistic. So markets moving are not just what the futures player do. The biggest initial impulse comes from the actual underlying market, which is massive. You think of the value of the 30 stocks in the Dow Jones. You think of the value of the 500 stocks in the S&P. You think of the gold stocks in the gold futures, the index that covers. It's massive, massive. It's huge. It's huge. And we need to know a little bit about what those people are doing. And historically in this business, there's always been a huge, at least for the last 44, 46 years or so, there's been a huge interest and use of waves. If you think of this market as just going up and down, up and down, up and down, those can be seen as waves. Sometimes when you get a big trending market, you'll see it really clearly. It'll run up, a little correction, run up, a little correction. They're like the waves that just come and crash on the beach. And the point is that the big investors, the big players in anything, equities, commodities, anything else, the vast majority of them have had some exposure or some training to two different forms of market analysis. One, and the most well-known one, is Elliott wave theory, developed by Ralph Nelson Elliott. And he came up with he was a sick man. He had tuberculosis, and while he was getting some country fresh air, that was pretty much the only thought to be the only cure for tuberculosis. He was on one of Charles Dow's farms, sitting there on the veranda, thinking about markets, and he came up with a theory that markets move in 5 waves in their expansive direction, and they correct in 3 waves. So as you can see here, you've got a 1, 2, 3, 4, 5 pattern and an ABC correction. Well, what Elliott said is he had a few rules, not many, a few. Wave 2 couldn't go below the start of wave 1. Wave 3 couldn't be the shortest wave. Wave 4 couldn't go into wave 1. Corrections would be in an ABC zigzag form. Now that's all he said. That was it. And I have no real argument with that. I see that occasionally. But what happened, of course, is that since then, the modern proponents, one of whom, of course, is Bob Prechter, who's a lovely gentleman. I've had the pleasure of meeting him. And him and a gentleman called Henderson, who's no longer with us, have added, I don't know, maybe another 100 or maybe 200 rules to it. And modern Elliott wave theory is incredibly, incredibly complex. And it's got a couple of fatal flaws to it. The first fatal flaw it has is that all Elliott wave theory produces a wave count, as the best fit for what the current pattern is doing. It also produces an alternate count, and the alternate count is pretty close to the opposite of what the main count is. So this is over science, over simplifying, of course, and being critical, which one shouldn't be. I know people who swear by Elliott wave theory. A lot of them come to me and say, I've lost so much money trading Elliott wave theory. But beside the point, that's the first problem with it. The second problem with it is the Fibonacci numbers. And for some reason or other, Elliott latched on to Fibonacci numbers and the Fibonacci sequence and said, this will control how far each of these waves go. Well, there is absolutely no reason to think that that is correct. Fibonacci numbers, or fibs as they're called, they should be called fibs because but what they do is tell lies. But that Fibonacci sequence came from a young Greek mathematician who lived in Athens in about 1200 AD, and he came up with a series of numbers. And that series of numbers actually describes perfectly the optimum mating cycles of rabbits. Rabbits were a very important source of protein to the ancient Greeks. Most people had a hutch in the back of their house and they kept rabbits. It was very hard to get protein back in those days. There were no supermarkets, there were no freezers. If you wanted to have some meat as protein, you had to find the day when the butchers were killing a beast, I should say, and probably beef or maybe lamb or goat, very popular back in that era. And you had to go in there and get your slab of meat, carry it home, and presumably eat it as quickly as you can before it went off, because salting the meat was the only known preservative that extended its life for a while. Now, I have no idea whether any of that's true, but it has at least as much currency and as much to recommend it as fibs being something to do with Elliott wave theory. They were a long way apart. From 1200 AD to 1930s. But anyway, that's sort of what one of the Elliott waves looks like. The next one is that, and the reason I got interested in this to start with, is that W.D. Gann, who I was a close and great follower of for many, many years, he said much the same thing. He said markets extend in threes and correct in ones. And if you have a look at this chart I've shown you here, there's a 1, 2, 3 on the impulsive side, the side the market's moving to, and there are corrections in between. So if you think about it, this is really exactly the same as Elliott's description of an Elliott wave. So two people with huge influence in the industry have both effectively said the same thing in different ways. And that's important for us because if we think about these markets, our Forex and futures market, being derivatives, incidentally, Greg, I know you, like me, you used to be a futures trader. I'm going to show you some of our futures trades this week. I think we need to brush up on our Forex. I meant to say we need to brush up on our Forex trading or on our currency futures. I mean, Trump's tariffs are going to cause absolute havoc in the commodity, in the currency markets. And great trading opportunities are coming to us. It's very exciting. So I managed to secure some of our trades for this week, which I'll show you a bit later on. But those of you who ever had an interest in Forex, brush up on your notes. I think it's going to be a very, very interesting time for us as traders. A bit of chaos, of course, is always wonderful for traders. We love chaos. The more chaos there is, the more markets move. And here we are, as we say, getting paid both ways. Getting paid when the market goes up and when it goes down. It's absolutely marvelous. Okay, so let's move on. You've probably read all this by now. S&P is a group of 500 stocks that are listed and traded on the New York Stock Exchange. And what the S&P futures is the derivative contract based exactly on what those stocks are doing. So if you get a big buyer, Berkshire Hathaway or any of the big firms decide they want to take a position in a particular stock, or more commonly a group of that type of stocks, that's going to move that physical market. And the same if they're selling. And of course, for us, we are trading that market with a premium or a discount as the futures market guys decide. So they're the three groups. Then there's the Russell as well. There's Germany's DAX, which is also a wonderful market. And there's a mini contract for the DAX now, folks. And then the commodities, of course, they're the cash value of each commodity. And the futures player is taking that cash value plus or minus a discount or premium, depending on the mood of the market. So if you think about it, for every futures buyer, there's a futures seller. So there's always an equal number of buyers and sellers. So if there are an equal number of buyers and sellers, what makes the market move? Well, one side has more urgent buyers who are prepared to pay a bit higher. The same applies to the underlying market. And the opposite of that, of course, is that there are the sellers of the underlying who will be followed by the futures contract are more urgent sellers. They're prepared to sell that market down a bit. And that's really what happens. And for us, we need to know about that because that's what we're doing. So here we are, what I've been talking about. Basel perceives that a certain stock or a particular group of stocks are undervalued, then that they have higher potential value, or they'll buy those stocks. Which stocks are in the index, then the index is going to go up and futures prices will go up accordingly. And there's a relationship between the futures price and the index, which is controlled by a group of vigilantes who are arbitrageurs. It's a wonderful word, isn't it? And these are guys who simply arbitrage all the time, meaning they're trading the difference between the cash price and the futures price. And when that gets out of sync, they'll act. They'll sell the future to get it back into the correct ratio that they believe is applicable, or the other way. So it's the arbitrageurs who enforce market discipline. So individual commodities, wheat, copper, all of those, they work exactly the same, and it's the exchanges that enforce the futures contracts with margin as the security. Now, at this stage, we're only ever talking about regulated markets run by the major exchanges. CME, Chicago Mercantile Exchange, is the big player for us, but there are other lit exchanges, and that's all we're talking about. We have nothing to do or even consider unlisted securities. We know too much about that. So most big players in those markets, cash or commodities or futures, I should say, they're using some form of wave analysis. They're making wave counts. Some of them are very formal about it. Others are pretty loose about it. I know one very, very good trader who simply says it's had enough waves. He doesn't interested in the actual count, but he has a minimum for each position. He said it's got to have X number of waves before I'm prepared to enter. Does very well too. So the big players, the big money movers, are following all sorts of waves from those two methods I've shown you, or others. There are many others as well. And if that's what they're doing, we need to understand what they're doing. So today I'm going to talk to you about an intermediate trend signal. And I'm going to talk to you about a concept called zero hedge. Wonderful name. I don't think it's called zero hedge. It's called not zero balance. Anyway, it effectively means that markets can be overbought, can be overbalanced in price, or underbalanced in price, and they can also be overbalanced in time. So it's called zero balance. There we are. The word came back to me. That's what this is called. And it used to be very, very popular. And for many of the big players, I've noticed, they still use some part of this. And that's what they're doing. You need to at least be aware of what they're doing. More importantly, you need to be a step of them, ahead of them. You need to know before they know. And the reality is that these great players, big players, don't know much. Consider the best hedge fund in the world for fiscal 2024, which was Citadel, made 24% on their invested funds. 24%, the best in the world. The top 20 hedge funds, the best 20, if you were lucky enough to be in one, made as an average 8.3%. Now, fees from these guys, which they're very, very good at extracting, average a bit more than 3%. So take that off your 8.5%, you're talking about 5 and a bit. Well, you could get that. You can get that on government securities for fiscal 2024 without too much of a fuss, and there's zero risk involved. What about everyone else who's not in those top 20 funds? Because most of them are gated, they're closed. A lot of them have been returning money for years. Are you a chance of being in one of those top 20 funds? Very unlikely. So you're looking at less, considerably less, than 4 or 5% net a year. If you learn to trade futures, go through all of these webinars. We have guys with us today who've been kind enough to create the testimonials that we show you. Mark L's one of them. Greg Palladini's another one. Been most generous to this firm, sharing his learning of trading time with us. And the percentages they're talking about, I mean, 24% a month wouldn't satisfy them. They're in 400, 500, 600% and more. Mark L, 1,000% paper trading. Natural gas for 2016. If you want to know where you are as a trader, paper trade, or call back test if you like. It's a much more acceptable word, isn't it? Back testing. Back test natural gas 2016 calendar year. work it out as a percentage, whatever your profit or loss is, express it as a percentage of the margin, which was $3,200 for that year, and you'll see where you're going. You should be somewhere around 450 to 500% plus, all the way up to 1,000%. We've got guys that have done 800, 900% on that exercise. So that's what you need to be aware of. But let's have a look at what we're going to show you today. This is US T-bonds. Can you construct a wave count for that would satisfy an Elliottian or a Gann man? Well, I couldn't. I never could. I've seen it all. I've done the courses. I've paid the proponents a lot of money, and no, it didn't work for me. And it probably hasn't worked for you. Look at what this actually is. What we've got here is in this market, there are 16 turns, and this is called, you can see I've got some little arrows and icons on here, and they're called BY up or BY down. This is from Beyond Masterclass, our new tutorial. You can learn all this stuff from me, one-on-one tutorial if you want to, or you can go now, it's available as part of the Teach Yourself to Trade video series at a much, much cheaper price point. Have a look at this. Just using these Beyond Masterclass signals, which are momentum signals, I've been talking to you about this for the last couple of months. These momentum signals are defining the moves, and they're either bullish upwards or bearish downwards. They don't actually all occur where these little icons are, but they're close to them. As a general rule, you can expect to get one of these momentum signals within 2 to 4 trading days of a significant high or a significant low. And you can see them all there. There's 16 turns. This is US T-bonds. Let's look at some more at that. Here we are. What each of these turns has created for us, every time we get one of these signals, it tells us there's a high or a low in place. So just let me get a cursor so I can show you this. It's not quite clear here. So this has a little sell signal in there. It's not a sell signal. I'm sorry. It's a directional indicator. It's a buyer signal. It's a trend signal, if you like. And once you've got that sell signal for the change of trend to down, that tells you that a high is in place. In the same way, if that is in a down move and a few days after the low, you get the opposite, which is an upward trend signal on the intermediate trend. Now, what do I mean by that? Well, remember that after what we trade, futures and Forex is highly geared. So for us, we have to take the apparent trend basically on a daily basis. In other words, any last bar on any chart should give us enough evidence we know what we're doing to make an opinion about whether that trend is up or down. That's how close we get to the market because of the gearing that is our great benefit. But the gearing can also be a great curse if you're on the wrong side of it. These are intermediate signals. And you can see through here, every time you get one of these signals, it's telling you that there's been a turn, and by definition, there must be a high or a low in there. In other words, here's a trend downward signal here. It stays in force all the way down to the low. Then a few days after that, you get the opposite side. You get a trend upward signal or a momentum upward signal. This is what I've been talking to you about. These are momentum bars that come from Beyond Masterclass. The minute that momentum signal is given, that tells you that this must be a low. In the same way, this must be a high, the minute you get that momentum signal. Some of them occasionally are a bit late, aren't they? Look at this one. It comes right on the last bar of this rundown. Why does it do that? There's always a reason. Remember, with markets are rational, orderly, and sometimes predictable. Why has it given us a signal right at the end of the rundown? You remember when I've talked to you earlier about this concept of momentum bars, this is exactly what markets do. They either continue the run, or they have a reaction and then continue the run, or they have a reaction and go the other way, which is what happens here. So why does that happen? Most of you say, well, what the hell's the point of giving me a trend is down signal on the end of the whole move, which has been going for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 days. It does that because the minute it creates that signal, it tells you that the high is in place. And if you know the high is in place, you can measure from the low to the high. And you can extend that measurement onto the next low. And you can be biased in your trading. You can start to say, I know this trend is up. I'm going to bias my buy side to be a little bit more exposure. I'm going to put a bit more weight on my buy signals. Or you might say, and I know people who trade this way, I'm only going to take buy signals. And sometimes you're going to get this biggie here. And if you knew that the trend was down way up here, it stays down all the way to this bar here. And then you get a trend up signal right on the last bar of that little 3-bar rally. Why does it do that? Because by doing that, it tells you immediately there's a low in place. And you can measure that low and you can extend it from the next high or any other high. And it's really interesting. And that's what a lot of these big, really big market moving investors are using, this sort of analysis. This is more accurate than anything else I've ever seen, to be honest with you. We had on the bond chart, we had we got here 18 different turns. On the other two charts I'm going to show you, they're each about 7 months long, and they're about 12 to 13 turns. So 24 plus 18, you're getting to 40. Of the 40 turns that this particular method of trading creates, there's only one that's not perfect. The others are perfect. Some of them come a bit later, others come really early. Have a look at this. This signal comes from the second bar down. This signal comes from the third bar down. This signal here comes from the second bar down from the high. Now, you'll already be in this trade because you're trading time or you're trading Danielcode price. You will already be short. These are not trade signals. These are intermediate trend signals. But you can use that, you can bias that to help yourself with the trading. Look here. There you get this intermediate trend signal, 1 bar from the low. You can buy that. You can buy the first correction. You can buy the ABC correction. You can buy this big correction down here. You can buy this 3-bar correction here. It just makes a pot full of money. You know something that others don't know. This all comes from the On Masterclass tutorial, which you can do one-on-one with me, or there is a TTT, Teach Yourself to Trade, Beyond Masterclass version. And with that, incidentally, if you wish, I'm happy to give you 1 or 2 hours of personal tuition, because people don't think about this stuff. I've been talking to you about this stuff for 2 or 3 months now. I'll bet none of you have put it on a chart like this. Okay, and a number of you have done the tutorial, done the either the one-on-one tutorial with me or the Teach Yourself to Trade version. So the Teach to Trade version needs a bit of expansion. So if you would like to have 1 or more sessions for me to talk to you about it, I will be happy to do that, because as I was saying to Jorn last night, who's with us here in the middle of the night, Jorn lives in the very cold country up in, it's Finland, is it, Jorn? I think it is. Anyway, he's one of those wonderful Scandinavian people, like my wife, who's Swedish. Wonderful stuff, isn't it? And this is information that you've had for months and months, but you haven't done. I bet you haven't done it on the charts like this. So what happens? Here you are. This is your trend up signal all the way down here, 2 bars from the low. It stays intact, it stays intact, it stays intact. And I've put a high on there, but I don't have confirmation yet, because in all this trading down here, there is no confirmed momentum bar. So this stuff is much more complex than it appears. You would swear this was a correction that would give you a high, but it doesn't go far enough to trigger a signal. And in fact, this move finishes going much higher, doesn't it? Okay. Keep thinking about this stuff. What am I doing here? Let's move on. I'm using the wrong tool. You've got to go back to something a bit. Okay. Here we are. Now, this is to show you that these trend signals are not your buy and sell signals. This is a piece of that same chart. This is a piece that's up, down, up, down, up, down, up, down. And what I've shown you is the time buy and the time sell signals in this little piece of chart. These are not the only buy and sell signals. There are others, but the point I'm making is you're not waiting for the trend indicator interim medium term tool to show you. This all comes with a tool that I will give you if you do the tutorial, of course, so you can create all this stuff yourself based on the Beyond Masterclass tool. But what I've put in here to show you is you're selling the highs and you're buying the lows, as you've always done with your Danielcode trading, in particular with your Danielcode time trading. But once you know that that intermediate trend is in place, the opportunities that you can add are absolutely huge. Yawn's from Belgium. There he is, he's with us. Well, that's pretty close. Just keep going north a bit and you'll get there. All right, he's a countryman of Frank DB's. Have a look at this, folks. This is the S&P E-mini, which you would not have thought was so well organized. So I've used this little pink coloring tool to show you what the waves actually are. Now, these are not Elliott waves. These are not Gann waves. I do not recommend that you have anything to do with Elliott waves. I do not recommend that you think that W.D. Gann is anything more than fascinating, because he never completed a trading system. Your trading system is the Danielcode price signal, or much better still, the Danielcode time, creating and trading Danielcode time signals. Have a look at this. This is the S&P E-mini. When we use these interim trend indicators, and as you say, if you have a downtrend followed by an uptrend, in the middle of them has to be the low. If you have an uptrend and the next move is a downtrend, it has to be the high. Look how incredibly accurate these things are. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. I think I said there were probably around 12. There are, between the three charts I'm going to show you, 40 signals. Only one of them has failed to give us a proper signal. And that's what happens up here. There's no sell in here. Here's your high. This is your uptrend here. This is your downtrend. And this here, you'd have sworn it had to have a downtrend signal in it somewhere, but it does not. And look what happens. Look how this bar runs all the way down and snap back. Can't wait to get away from that low. Same thing here. Punches out the low. Just punches out the low. Runs all the way back. There is no, in this whole thing, there is no, for 11, 12 days odd, there is no downtrend signal. So in fact, this is not the high. This is the high, because it actually runs all the way straight through here. So on this chart, we're talking about 110, 115 bars. These 11 bars through here are the only stage at which we've had any doubt what the market was doing. The rest of the time, we've known exactly what the market's doing, because once we have these signals, and I've told you of the 40 that I'm going to show you today on the three charts, there's only one or two failures of this nature where you would really think that it stopped working. It hasn't. In fact, that wasn't the high. Here's the higher high comes in here. That's the end of that rally. If you're just using your eyes, they'll deceive you. You have to have a system. You have to have a mechanical system. All of these little red and blue arrows on here, triangles, they come from using the Danielcode trading tool. Many of you have got it. You've never used it this way. Once you know the trend, you can add value like mad. You can stay in the trades a bit longer. You can use a bit of bias in your staking. You can double up and say, here's a nice big trend down. You don't know it's a big trend, but here are the other trends. Okay? Your Danielcode time trading is going to tell you exactly when to get long, so don't worry about that. But you can say, here's another sell signal. Here's another sell signal. Down she goes. Final sell signal. Up here has not yet given the upward trend signal. Looks like these two bars are big enough. You'd have thought they would have. They haven't. Amazing stuff, isn't it? You don't have to second guess this stuff. It's either, these signals are like light switches. They're either on or they're off. That's all that happens. Let's move on. This is wheat. This is the overbalance. This is what so much of the huge long-term stock investors use. And what they're doing, this is pretty simple, just where you can see what I've given you here. Here's your trend down signal. Goes down all the way, all the way, all the way. This is your first trend up signal right down here. That tells you this must be a low. And then we get this little chog, chog, chog. How you can put any wave count to this, I don't know. But up, down. Look at this. This is where it fails. I'm expecting that this would be a lower bar that would give you the downtrend signal. It doesn't. Okay, that's why I put fail on it. That's okay. Danielcode sell signal on that bar there. Another Danielcode sell signal on that bar there. And a third one on this bar here. But once you know how to create these waves, if you want to call them waves, these can be Daniel waves or Needham waves, or any sort of waves you like. They are not Elliott waves. We have nothing to do with Elliott theory. They are not Gann waves. We love and adore Gann, and I was a Gann man, the chairman of the Gann Admiration Society for 12 years or so, did nothing else except Gann. But he doesn't actually ever produce a comprehensive trading system. Have a look what I've done here. This is the last move down. Sorry, the first move down. This is the market rallying. This is your trend up signal here. This is this little pushback here. I've taken that, the length of that, gone from that high to that low. That's the first important pullback, and I put it on that high up there. Okay, look where it comes. This little diamond triangle here is accurate. That's where you actually got the first signal the day before. Look where this bar stops. That gives you the signal. A couple of ticks above that number, and that tool which you have on your Trade Navigator, it won't take 1. So if you're looking for equality, you've got to make it 1.01. It will take that. It might on some markets take more than that, but it's close enough for what we're doing. That's telling you that this market has had an overbalance. Overbalance is give you a sell signal on the technical side of this analysis, but you've already got it. And more importantly than that, you've been short from where it says high, because that's a Danielcode sell signal in time and in price. You got short on the next bar. You've been short 1, 2, 3, 4, 5 bars so far and looking for the rest. Saying, go, you good thing. This is what you can do by an understanding of what these markets work. And what's come out of this work I've done on momentum studies, which is where Beyond Masterclass comes from, is absolutely incredible. And look at this, you're seeing the benefit of it. Same thing here. This is that same wave count using the Beyond Masterclass. And what I've done here is I've taken the first rally up and I've extended it from the low. So this is the last rally here. Here's your swing low before the final low. There's your last rally from there to there. I've extended it from there. This is where it comes in exactly at 1. Look what else is on this bar at exactly the same point, and it's not a coincidence. That's your trend. Trend is up signal. And that stays all the way. Eventually, there's your sell. 4 bars later, 5 bars later, you get confirmation the trend is down. Right here, this is your trend is up signal. Intermediate trend means this is a low. Has to be. Can't be anything else. Once you've got that, you can start to measure it, and you can extend it onto the next chart. I hope this is fascinating to you, and I hope I'm not being too boring going on and on about it. I mean, as I often say, no one is more amazed about the magic of the Danielcode than I am. And I've been doing this now for 35 years in one form or another. And to me, it's just extraordinary. Here's that same wheat chart. This is a step away view of it. Exactly the same stuff. You can do this if you do the Beyond Masterclass course. And it's also available on the Teach Yourself to Trade business. So this is the Danielcode Masterclass tutorial. If you seriously want to be an outstanding elite trainer, this is what you should do. This is with me one-on-one. And we have wonderful endorsements there from Mark L., who's with us today, and Greg Palladini, who's with us today. Wonderful people, most helpful. And this is your TTT video series with the new lesson 5, the power of momentum bars and more. When to use a 2-bar stop, when a consolidation sideways move is starting. It tells you when to trade and when not to trade. And that is an absolute gift, isn't it? Number of times you've got caught in a sideways consolidation, chopping up, chopping down, chopping up. This will tell you when it's forming, when it's happening. You will already have lost some money. You'll have lost 1, maybe even 2 trades. But these consolidations typically go on 7, 8, 9 days. I've seen them go on 40 days. And you just keep getting chopped up. Either way, you're wrong. With the Beyond Masterclass course, one of the indicators tells you when that consolidation is happening. Okay, this is simply going to show you some of the trades we've made this week. And this is crude oil running up very close to its flip me point. I've updated all those flip me points incidentally. This is gold. We've got a TO3 blue line sell signal in gold. It has not been triggered yet, but the correlated sale in silver has been triggered, which is a very interesting position, gold. Make sure you're right on top of the Danielcode signals with that. This is what silver did. There you are, 2 bars down. It's not big. It had a nice move down to 33.61, and then it rallied all the way back when it realized gold wasn't going with it. Had a fright. Oops, sorry, I'll run back half of this. Here's wheat. Today's sell signal, straight down. 2 bars, nice little trade, nothing fancy. UST bond, a TO3 plus buy signal. Nice trade, looked better earlier today, run all the way back. These markets are looking for some clarity. Here is what I wanted to show you. This is the Aussie US dollar pair. Okay, nice trade down. Got down to the black line at 62.74, got to the next level at 62.70, said not for me, and rallied about 30% of the way back. But that's a high momentum move, and it's across all of them. This is the euro, Japanese yen pair. Same thing as TO3 and blur line. Excuse me, there's always a typo, isn't there? That's what comes from doing this stuff at 3 and 4 o'clock in the morning. TO3 and blue line, a sell signal, please. There it was today. So I'm saying it's time to brush off your skills on currency trading, Forex trading. If you don't like Forex, there are currency futures available at the CME and other places. Here's the Euro USD. This is the Euro pair. Blue line, TO3 and blue line trade. Looks much like the rest, doesn't it? But nice trade. British pound, Japanese yen. Same thing. Down it goes. Nice trade. Here's our Kiwi, the TO3 and blue line sell. Took a day, I had to think about it. It had a better down day today, but I think that this is all moving to something. I think it's going to be exciting. Here's the 4th seal, folks, for this week. This was posted on Monday. You can subscribe to this. Frank DB writes this commentary for us and keeps the charts. You can read the bottom part of this. S&P remains in the downtrend. First opportunity for a low comes on March 25 on a cluster there. If it inverts into a high, we should see a high form there, followed by even lower prices into the 44.29 cluster. And he has charts with this. You can see where these clusters of time signals are. And you can subscribe to this. It's $125 a month per market. Frank, $30 a week. Frank does S&P, crude oil, and gold. He has a lot of followers of gold. So that's pretty much for us, folks. If you haven't already had a free trial, please do so. Go to the Danielcode website, click your free trial, hit the register button. Any problems with that, if you already had a trial, the computer will remember you, and it's mean and nasty and doesn't want to give you another free trial. Contact Terry if it's been a reasonable period. We'll be happy to give you another free trial. Finally, this is our disclaimer. We want you to read this, and we want you to be really serious about it. If you've got in a car and you don't know how to drive, you're going to either hurt yourself or hurt someone else. Or you're going to kill yourself or kill someone else. If you don't know what you're doing, don't go into these markets. They are wonderful markets, but it's very easy if you don't know what you're doing. It's very easy to lose all your money and more. By the same token, the good news is when you do know what you're doing, it's equally easy to make a whole lot of money, and that's what we teach you to do. So that's us for today, folks. I do hope you've enjoyed it. Thank you for being with me. Mark Kay's arrived. Lots of guys will come in a little bit after the start today. Wonderful to have you. Akshay's with us. Grand. Adrian's with us. Yes, of course, there's the other Adrian. 3 of them, as usual. Lovely to have you, and thank you, Ewan. I'm glad you enjoyed it. I will look forward to talking to you at our next webinar. And if you have any particular topic you'd like me to cover, please drop me a line. Email jneedham@thedanielcode.com. Let me know what you're interested in, and I will provide some material on that topic at our next webinar. For us, that's I'm off the clock. I've placed my orders for tonight, you're tomorrow, and it's 11:34 on a beautiful sunny Friday morning, and it's time for a Bloody Mary. And I'm going to think of you guys as I enjoy it, and perhaps more than one. Bye-bye for now, and thank you for being with me. Bye-bye.